Good day. My name is Professor Anthony Ravicchio. I am founder of the Financial Advisors Group and CEO of Ravicchio Online Income Tax Advisors. This is also being recorded on Tuesday, Veterans Day. So yes, I'm also a U.S. veteran, and as I indicated earlier, a college professor on personal finance at both Monroe College and Lehman College. And now we get rid of all of that and talk about the reason you're here. Grab a pen, ladies and gentlemen. We're going to be talking about income tax planning for investments. Very, very good subject. When I teach it in college, it's normally what I would call a 3-hour lecture. We're going to try to take 3 hours and condense it maybe to 10 minutes. So I got some paperwork I'm going to refer to every now and then. Most important, please grab a pen. Please take notes. So let's talk about tax planning on investments. When I talk about investments, right, what are we talking about from the IRS point of view? We're talking about an asset. So when we talk about investments, we're talking about an asset. And an asset increases in value and decreases in value. And what do you do with an asset? Well, you buy it, you can keep it, and then you can sell it. And in any one of those three situations, taxes are involved. So you never want to leave money on the IRS table if you don't have to. This is why we call it tax planning on investments. Again, grab a pen. So we're going to talk about quickly 4 strategies that I talk about in class and with clients. So let's get to the first one and let's talk about a strategy in regards to your capital gains. And please understand, when we talk about capital gains, you have to look at your capital gains in 2 areas. One is called your short-term capital gain. The other one is called your long-term capital gain. What is the difference between short and term? Short is if you've had this asset for 1 year or less. Long-term, therefore, would be 1 year or more. Why is that important? Grab a pen. It's important because whatever gains you made on the short-term basis, let's say for 1 year or less, well, you have to pay what's called your tax bracket. You have to pay your tax bracket back in taxes off of the capital gains. Most people in the federal, city, state, put it all together, tax bracket, you're looking somewhere between 35-40%. I normally like to say 40% to be more liberal. So again, right, for every dollar that you have as a capital gain, short term, right, holding it 1 year or less, it's a 40% tax bite. What is it if you've had it for 1 year or longer? Well, it varies. It varies from 0% to 20%. Let's cut it in half, we'll say 10%, again, because it's on a sliding scale. So obviously, buying and selling long-term and keeping long-term investments, getting it to long-term investments from a tax standpoint is very, very important. Now, I'm going to share with you a second strategy. Let me go back to the first one for a moment. So how do you do that if you're not actually sure, right, with any of these strategies? This is why we have income tax and financial advisors. If you have one, speak to him or her. If you don't have one, feel free to give me a call. We'll talk about that later. Strategy number 2. And now grab a pen because I'm going to show you how strategy 1 goes into strategy number 2. Strategy number 2, I share with my clients towards the end of the year, around this time of the year. We look at their portfolio. And the strategy is called tax loss harvesting. I know, nasty name. I'm going to try to simplify it. What it is around the end of this year, you've had your investments now for 11 months or more, maybe 11 months or less. And we want to look at which ones brought you capital gains, right? Short term, long term. And God forbid, you might have had some capital losses. And the harvesting strategy goes, well, if you had a gain, if you had $1, that's wonderful. And you have to pay taxes on that dollar, but we'll come back to that in a minute. You had a gain, $1. Well, now, if you have 40 cents in losses, or 50 cents in losses or 30 cents in losses, let's say 50 cents in losses just to clean that up. Well, now you made a 50-cent gain, not a $1 gain. Yes, you still have to pay taxes, but now you're paying taxes on the 50 cents. To give you a more real example, let's say at the end of the year, you had a $2,000 gain on your investments, and you don't know if it was short-term or long-term. Well, if you had a $2,000 gain, and again, if that property, that asset, was 1 year, you held it for 1 year or less, well, you probably pay about 40% in taxes, or $800. If it was an asset you had for 1 year or more, well, then you only have to pay taxes on $200. So again, right, see some of the strategy involved? And let's also say you also had an asset that brought you $500 in losses, right? Well, with the long-term investment, right, that $200 tax bite would automatically be written off. With the other one, right, that's $800, well, you just written off $500 from that. And of course, to implement that second strategy, like the first, you want to sit down with a financial advisor, an income tax advisor, some licensed professional that is aware of how investing works from a portfolio point of view. So, strategy number 3. When we talk about investments, you want to be able to be what I call a tax advantage person. Right? Because we all pay too much on taxes, right? Including me. So, you also have to understand that there are tax advantage accounts all over the place. Your financial institution, your life insurance company, your savings account, your brokerage account. You just have to know and understand what they are. Today you could get things like 401ks, 529 plans, tax-free bonds, IRAs. Some of these accounts are tax deferred. Some of these accounts are tax advantaged. Tax free. Whether they're deferred or free and which one helps you better, again, is a matter of number crunching and your financial advisor. All of them will save you money on taxes compared to not investment tax advantage accounts, but non-tax investment accounts or even savings accounts at your local financial institution. If you want to learn how to save and invest properly, you want to get away from having to pay taxes on your investments as well as your performance, right? So it's very important that you learn about tax advantage accounts, and these are based on lifestyle, right? So when I mention 401ks, right, I'm talking about an account that's geared for retirement. IRAs, right, geared for retirement. 529 plans, those are geared for college plans. Tax-free bonds. Well, tax-free bonds is for anyone really that's looking for guaranteed interest, right? So let's go now to the fourth example. Probably my best and funniest example, because I'll give you a real-life client example. It's called donating, right? And remember, we're talking about an asset, right? For most of this conversation, we've been talking about investments, thinking about money, right? Stocks, bonds, mutual funds. There's all kinds of assets we have in our life. So a client gave me a call. I'm going to make a long story short, but I hope to make a point. I had a client that gave me a call, said, Anthony, I'm looking to sell my car. And as we were talking about, the tax implications and other implications of him selling his car, I asked him, how was it going? And he kept telling me how frustrated he was that, he was getting calls and they were coming to check it out. And he was trying to sell it for $10,000. And they kept trying to bring him down, 9, 8, 7, 6. And he was getting very frustrated. He didn't know what to do. I said to him, look, why don't you take that asset and go to the local church? And he said to me, why? And I gave him this example. I said, if you sell your car for $10,000, you have to report it as income. As with most areas of income, and that would be one of them, you have to pay taxes on it. Again, as I indicated before, most tax scenarios are based on our tax bracket, right? So that 40% of $10,000 would be $4,000 in taxes. So starting off, he'd only made $6,000. He might get some of that back in his tax refund, but right there, he only made $6,000, right? he can do that, right? And as I indicated, he ain't going to get it for 10. It looks from what I was speculating, he's going to probably have to sell it for 7. But I said to him, give it to your local church, just get a receipt. That's what he did. And when you do what's called donated property, that's what it's technically called in IRS terminology, you get a 60 cent to $1 credit. So his $10,000 car, he got a credit from the church to the IRS for $7,000, because again, the credit is also based on the actual car, the model of the car, etc. So he got 70% back on his return. So those 4 areas, and let me cover them again, and forgive me, I'm looking at my notes because I'm a veteran with bad eyes. When you talk about looking at capital gains, right, tax loss harvesting, different type of tax advantage accounts, and donating, and there are many other strategies, but I'm going to leave us at that 4. Those 4, when it comes to tax planning on investments, will save you hundreds and thousands of dollars per year if you tax plan. That's why it's called tax planning. You don't do it at the last minute. You plan it in advance, right? And of course, the end of 2005 is coming near. So if anyone has any questions on this video, or any question at all from a tax point of view, feel free to give me a call. 347-575-5045. Be tax smart and say thank you to a U.S. veteran. Have a good day.